Good morning, good evening, good afternoon. I'm Kamari Ellis, and this is another edition of Ask Kamari. This is the Investment Basics Challenge, our 30-day plus challenge. Today we're going to talk about risk tolerance. Now, what exactly is risk tolerance? That's another one of those fancy industry words that you hear a lot of financial advisors and financial planners throw around a lot. But basically what financial tolerance is, or excuse me, what risk tolerance is to see how a person will deal with risk. A couple years ago, 2008, in October, we saw the stock market crash. I mean, it literally jumped off of a cliff. So how did you deal with that? Think about that. Now, for me, this is kind of where, this is one of the sour points I have with my overall industry. I think risk tolerance is poppycock. I really don't believe in it. After all these years in the industry, I've seen that people's attitudes change when the markets change. Now, again, risk tolerance is usually a questionnaire designed by a bunch of psychologists and therapists, and they try to gauge and see, well, how will you deal with the stock market swinging up and down? If the stock market is up 50% and then it crashes 50%, how will you deal with that? Will it keep you from sleeping at night? What I say, again, like I said earlier, is that people's perspective on the markets changes and their risk tolerance changes as the market changes. People are greedy, and people are also fearful. That'll be another video down the line we'll talk about also. But when you see the market doing well, people tend to want to invest more. People want to be more aggressive. I never forget, I had a client who told me I had invested his money too conservatively. And this was about 2007, just when things were starting to get awry. And I let him know, but he said the market's at all-time highs. I want to participate in those. But unfortunately, he couldn't really see over the ridge and say, there is always a possibility for loss. So this goes back into the whole educational thing and just looking at the markets. So he really got on me for having a lot of safe investments in his portfolio. Now, about a year later, he actually thanked me for being a bit more cautious and being a bit more tedious when it came to staying fast with being conservative with the money, because I know markets swing up and down, and I knew this particular person couldn't be able to really deal with those swings. But what I think is really more important, which we talked about in the last video, forget about your risk tolerance. It's really your time horizon. So when do you need this money? And that can really help to shape and mold and see where things are at. You can look at different statistics in terms of how the market has moved. For example, there's an average out there that they say the stock market in any 20-year period has been up roughly anywhere from 7 to 10% on average each one of those years. And now, of course, you'll have some years that are dips and some years that are great or better than others, so it kind of smooths out. But if you know you have a 20-year plus time horizon, you can probably be a bit more risk, or you take on a bit more risk. So that's day 5. Day 6 is coming up. Day 6, we're going to talk about the law of supply and demand. So stick around for that, and I hope you're enjoying these. If you have any questions, comments, or concerns, feel free to drop me a line on Twitter or over on AskKamari.com. I'll see you soon. Bye-bye.